So negative 47.6% autocorrelation. That's a really big number. In terms of something in the past being correlated with something in the future, that's an edge I would take. Is there a metric that can tell you whether or not there's a relationship between what happens with the price of an asset today and then what happens the day after? Well, it turns out there actually is, and we're going to use the autocorrelation function to do it. Previously, we had seen how correlation is a useful metric to see whether or not two financial assets' returns typically move alongside each other, inversely to one another, or nothing alike at all. And that's really interesting, but it doesn't tell us anything about causation. It doesn't give us some idea that if something happens today with Bitcoin and Ethereum, that I could make a prediction with Bitcoin and Ethereum tomorrow. And for trading, that is really useful. Being able to try to look into the future and predict things is a really handy tool to have. But that doesn't mean that correlation here is useless. Far from it. In fact, I think you're going to find this very insightful, because what if we just took, for example, Ethereum's returns and lagged them by 1? If we lag them by 1, we can now compare the Bitcoin returns to Ethereum's at two different points in time. And now we're looking at whether or not there's a dependency in time, if there's a correlation in time between Ethereum's returns and Bitcoin's returns. And that could be a really interesting calculation to do. But why not actually take it a step further? We could take Bitcoin's returns and copy that series, that column, and just lag it by 1. So now we're comparing Bitcoin against itself in the past, and we can perform the correlation calculation on that. And this is known as autocorrelation. We're comparing something versus itself. Therefore, we could see if there's any Granger causality type inference we can make about whether or not we can place trades based on whether Bitcoin's price went up or down and how that might be correlated with the future. When we're talking about causation, what we're really saying is something typically follows some other thing. We're not saying that it causes it. We don't know what causes it. We know that it typically is followed by this. In reality, there's so much trading activity that happens with Bitcoin. I'm not even going to bother analyzing it for autocorrelation right now. I'll leave that to you if you want to do that as an exercise. I'm going to do it with a crypto that I found, XEC USDT, and there are many such cryptos. In fact, I've also linked the Python code as well for you for where I went to discover which cryptos might be autocorrelated. Taking a quick look at the math notation as well, we can see that we had our standard correlation formula before, where we took our xt minus x bar, so x at any point in time minus its average, and got our covariance by multiplying that by y at any point in time minus y's average. And this x and y at the time was representing Bitcoin and Ethereum. And then we just divide that by their two standard deviations. And here you can see I've got the formula for standard deviations written out in full. So how do we get to this, to an autocorrelation math notation? How do we describe this mathematically? Well, first of all, we're not dealing with Ethereum anymore. We're just going to look at x of t. In this case, it's actually representing XEC now, not Bitcoin, but we can call it x. That's the nice thing about math. So we can get rid of those y's completely and replace them again with x's, except now it's not going to be the x at times t. It's going to be x at times t minus whatever lag, whatever number of periods we want to lag by. And we're going to use lag 1, but I'm going to use the letter L here to represent the lags. And also to get this, let's call it the covariance of x with its lags, I need to actually do this as of from lag plus 1. I mean, if I looked at a price series, let's just draw one up here. I've got, I don't know, returns of 5.0, 4.2, yada, yada, yada. And then if I copy that and lag it, you'll see that I'm missing one data point here. So in order to get the covariance of, say, these two numbers, what I actually have to do is start from one number down in order to have two numbers to compare to. So in our sum here, we're going to start with time t, which is equal to the lag, whatever number of lags I have, plus 1. Because we are dealing with x and x only, not y, I can just remove this y-based standard deviation completely and leave x as of t minus x bar squared and remove the square root, because that just saves me writing out x of times t minus x bar twice. So removing the square root because it's no longer necessary. I just need to do this by xt minus x bar squared, because that's the same thing as the standard deviation times the standard deviation, so without the square and the square root. And standard deviation times standard deviation is just the variance, which is what we can show here. This is the price data we're going to be working with. And here I've calculated the returns. I'm using log returns. You can use simple returns if you want to, i.e. the percentage change. And what we need to do is follow this formula. So here I've got x of times t minus x bar, so the average. So first of all, we need an x bar. Let's put in the big T here and count how many data points that we actually have here. And that's 404 data points. And then our average as well. So x bar, which is just going to be the sum divided by the count, or we're just going to use the Excel formula now, which is equals average. And that should give us our average number over there. Okay, great. We've got our average. And therefore, x of times t minus x bar is simply just going to be equal to our x over here, which is our return for XEC USDT, minus our x bar. Fix that and drag that down. So here we have essentially XEC versus itself. And then we need to take x of times t minus L, and the letters for this L symbol are ELL, so L. X of times t minus L, which is the lag. So L is going to be 1. This is a lag of 1. That's going to be x of times t at lag 1 minus x. In other words, we're going to take this number over here. This is essentially the same thing. So this is x of times t minus 1, which is this number, minus x bar, which is just this number we calculated up here. It's just one row above. So that's how we're going to do it. And let's drag that down over there. So there you go. We now have our x of x bar and our x of times t minus L minus x bar here. So here I'm just going to put x and then L there so that you can see that is the lag that we're working with. In fact, what I like to do is just put L1, and that tells me that this is a lag of 1. Perfect. And then we need to square this, the xt minus x bar squared. So here it's going to be x minus x bar, and I'm just going to put this in brackets here and show it with the caret and the 2 to show that that's squared. So here I'm just going to say x minus x bar squared. And let's drag that down here. Perfect. Now let's calculate our autocorrelation. So here I'm going to call this rho of L, rho meaning correlation, and that's that symbol over here. And here we're just going to say, okay, we have our covariance. In fact, we haven't calculated our covariance. Let's do that very quickly. So our covariance of this asset minus itself, so x L1. And that covariance is very simply going to be, in fact, we can't start it up there. Remember, we have to start it from lag plus 1. So I'm going to go down 1. And that's going to be this number multiplied by this number. In other words, it's this here multiplied by this here. And there you go. There it is. And let's drag that down. There's our covariance. So now we can sum that, which is what that big sigma up here is for. We're going to sum this column. And we're going to divide that by the xt minus x bar squared sum. So xt minus x bar squared sum, which actually is this entire column. We start here, including the first data point. So we start with the very top row and we go all the way down here. Now the formatting of this is bizarre. Let me just get rid of percents here and just show these as numbers for now. So there you go. We have 0.47, so negative 47.6% autocorrelation. That's a really big number in terms of something in the past being correlated with something in the future. That's an edge I would take. That's really, really interesting. So the question becomes, is it too good to be true? And the answer is, well, we can actually do a significance test on this using something called the Young box test, which tests, it gives a p-value to say whether or not this was very significant. I'm not going to get into that statistical test right now in this video. It's not a very long test, but I don't want to make the content of this about that test. So we'll come back to that. But just know I have conducted that test on this data, and this is significant. This data, it's very improbable that this is just a fluke. Exciting stuff. We've only calculated this for one lag though. Let's do lags 2 and 3 very quickly before we actually look at some potential trading results. I have a very strong autocorrelation here on lag 1, but very, very weak. Almost no autocorrelation whatsoever on previous lags, meaning the very previous time step is the useful one. It's the one we care about. And just to illustrate this on a bar graph, in fact, let's do it on what a typical autocorrelation chart would look like. Here I'm going to put row lag 0, meaning that would just be 1. Something against exactly itself is just going to be 1. And so let's go and plot this here as a bar chart. So there's our lag 1, a perfect 1. And I'm looking for another significant bar, which is this one over here. We're going to take this video even deeper now, because we know that there's some autocorrelation with the previous time step to the current. And so I want to know, which is it? Is it based on whether or not yesterday was up and then today is down? Or yesterday was down and today is up, or yesterday was down and today is down, or yesterday was up and today is up. Which is it? Where is the autocorrelation? And one of the things we can do to try to ascertain that is to look at some state transitions. And so state transition is very simply saying, let's call the state of yesterday an up day, then the state would be 1, a down day, let's say the state is 0. So what is the probability of transferring from a state 0 or transitioning from a state 0 to a state 1, or from a state 1 to a state 0, from a 0 to a 0 and a 1 to a 1. I'm going to call this state, and here we're going to transition from 0 to 0. So that's if we're on a down day, do we go to another down day? And then here it's going to be 0 to 1, and then here we'll do 1 to 0, and then finally 1 to 1. We'll just say here, if, for example, our returns are less than or equal to 0, we'll just call that a down day. Otherwise, we'll call it an up day. And so that's our state. Was it a down day or an up day? So we know that we had a down day, an up day, a down day, an up day, a down day, a down day, an up day, and so on and so forth. So here we can see whether or not the returns went up or down. We really just need some true or false outcomes that we can sum. So if it's true, we'll call it a 1. If it's not true, we'll call it a 0. And so here I can just say if, for example, and if that is equal to 0 and that is equal to 0, then put a 1, otherwise put a 0. So that's saying, did we transition from a state 0 to a state 0? And we didn't, because we went from a 0 to a 1. So let's drag that down. And then here you can see we had a state 0 and we transitioned to a state 0. And we're going to call that 1. So this is signifying that this was true. This actually happened. And here we can see it happened a ton over here as well. Now let's copy this across. And this is from a 0 to a 1. So let's change this over here to 1 and drag that down there. So we went from 0 to 1, 0 to 1, 0 to 1. And that's flagging when that was true. Now this is a 1 to a 0. So let's say the current one is 0. And that was coming from a 1. And we can drag that down. And then this one here is going to be 1 and 1. So if that is equal to 1, and this one here is equal to 1. And we drag that down here. Now let's build our truth table over here. So did we go from a 0 to a 1? So let's say here our current state is 0 or 1. And our next state is 0 or 1. So what is the probability of going from a 0 to a 0? Well, then we can just sum up this column over here as such. And that gives us 108. That happened 108 times. And then here, in terms of 0 to 1, that happened 112 times. Let's copy those formulas down here. And then from 1 to 0, that happened 112 times. And from 1 to 1, that happened 71 times. Now let's give this some quick formatting over here, just so we can see what the indexes are. And just to be clear, this vertical side here represents the current state, and this part here represents the next state. In fact, I'm just going to make that really clear over here. Let's go ahead and center across selection and just call that next state. And this here represents the current state. So I'm going to copy this down over here. And now let's do this as a percentage. And in fact, to do that, I'm just going to sum these guys here, sum those to get the totals. And then we can divide everything by the total in order to get a summary. So again, I'm going to just give that some formatting here. So I'm interested in the percentage from the current state. So for example, here I could say, if we were at a next state 0 from a current state 0, what is that divided by the total here? That should give me the percentage. In fact, let's put that in a percentage format over here. So that's 49.1%. And then let's do the same here. In fact, let me fix that there. So 49.1%, drag that across. This one here is 50.9%. So it's about a 50-50 chance that if I'm in state 0, I'll go to a state 0 or state 1. That's not really of any interest to me because that sounds like any sort of trading situation. There's about a 50-50 chance of it going up or down. But let's now drag this down. This is where it gets more interesting. If I'm in a current state of 1, or if I'm now in a current state of 1, the chances of the next state being 0 is 61.2% and 38.8%. I say the chances. This is what happened historically. Very interesting. Let's run a quick backtest with this to see if we can actually formulate a trading strategy, and therefore what would the returns or the cumulative returns in my portfolio actually have looked like. So the strategy that we're going to use here, given that if we're in an up day, I think the next day is going to be a down day, is a shorting strategy. So the way I'm going to do this is just create some columns over here, couple columns, and I'm just going to call this bet, right? This is the bet. This is the strategy. A more fancy word for bet is we're going to use the word strategy. And I'm going to say here that, okay, here I know that this is a down day because it's negative. So if that's a 0, I'm going to do nothing. But if it's a 1, I'm going to do something. So here I'm going to say equals if this here, this return that I just had, is greater than 0. In other words, if it was a 1, then let's say I placed a bet. In other words, in fact, let me do it down one row. I'll say if the day before, this is my signal over here, is greater than 0, again, in other words, it's a 1, then let's say I had placed a bet on that day and I got that price, which, by the way, there's a lot of look-ahead bias and issues now in backtesting that come up, but this is not a backtesting video. This is a rough and ready gauge as to whether this would have worked or not profitably for me. Let's say I went and shorted it. In other words, I got the opposite of the return of this day, right? I closed it at the last price of the end of the day and I got that return, but I got the negative because I shorted it. Okay, great. Hope that makes sense. And then over here, I would have got 0 because I would have placed no trade there. But here I would have placed a trade. And you can see here, because it was an up day, I shorted it at that close price and I closed that short here at this close price and I got the negative of this return, which is a positive 0.3%. This is not taking into account trading costs or anything like that at all. And let's just see what would have happened over here. So let's go back to the top. And let's come up with my cumulative returns over here. So here I'm just going to say this is equal to 0 because that's the day 1. And then the cumulative is just going to be that last step plus the current. And let's drag that down and let's create a chart as to what that actually would have looked like here. And indeed, you can see, so here we have our cumulative strategy returns. And very interestingly, you can actually see here that this would have made money, not taking into account any trading costs, not taking into account look-ahead bias and all sorts of issues that are fraught with backtesting. This is just to go and show that autocorrelation, which here it's an objective measure here, is present. We've been able to determine it's present. I'll put the Young box test on the spreadsheet that I upload for you as well, just so that you have that there and you can see that it is statistically significant. And we've seen that with a lag of 1, that's where the significance is. And we formulated a strategy around that based on the state transitions of whether we were on an up day or a down day before, and therefore could we make some kind of return. And so here we have this output. Of course, this could all be automated. If you're a programmer, you can go ahead and automate your analysis and strategies around this. I found when going through the Binance data, it was typically tokens that were quite fresh that showed autocorrelation. I don't know if you find the same. Remember, if you find any issues that you think are glaringly obvious and you want to make other folk aware, help each other out, post it in the comments. Hope you found it useful. Till the next one, take care and talk soon.